Well, hi, everybody. I'm Ric Edelman. Thanks so much for joining us on today's webinar. This is going to be a really awesome conversation, taking crypto beyond Bitcoin. To have this conversation, there's nobody better than to do it with Matt Hougan. Matt is the Chief Investment Officer of Bitwise Asset Management, known very, very well within the industry, both in the TradFi world as well as the crypto world. Matt, good to see you again, my friend.
It's great to be here, Rick. Thanks for having me.
Matt is one of the OGs of the space, one of the originators in the ETF world, way back when nobody knew what it was or believed they'd hang around. You guys created Inside ETFs and ETF.com and made the leap from that to crypto, pushing 10 years ago with Bitwise, the oldest and largest crypto company. Talk a little bit about your journey, Matt.
Yeah, well, a similar journey to you, Rick. Also an ETF OG who has transitioned into crypto predominantly. Yeah, I made the switch after we sold ETF.com in 2015, didn't earn out, then moved over to Bitwise. Bitwise, of course, one of the world's largest crypto asset managers at this point, with about 16 billion in assets under management. And a lot of people wonder why the switch from ETFs to crypto. Why do you see that so often? And there are these huge analogies, right? ETFs were a disruptive new technology that people weren't comfortable with, that they didn't know it would work, that people were skeptical of. And I think those of us who were early in ETFs saw how a disruptive idea can go mainstream and take over much of how finance operates. And we looked around at crypto and saw the same thing, a disruptive technology that few people trusted, but we thought was going to be a big deal. I made the leap to Bitwise 2017, as this slide shows, created the first crypto index fund. Now we have multiple crypto ETFs, I think 30 plus around the world. Did some of the foundational education, like writing the CFA Institute's first ever guide to crypto, and have really seen this industry grow up, enter the mainstream, and I think it's about to take another leap forward in the coming months.
Really rather fascinating as we look at the history and where we are today and where we think we're going to go. That's what we're going to get into here. A lot of you have sent in questions when you registered for this event. We will pepper Matt with those. You're also welcome to offer questions as we go based on the conversation you hear. Just go to the Q&A box and type in your question. I'll be taking a look at those as we proceed and throwing them at Matt as well. Matt, way back in 2015, when you joined Bitwise and Bitwise got its foundation, Ethereum was brand new that year. That's when it launched. Prior to Ethereum, there was Bitcoin and nothing but Bitcoin. There really, if you were going to do crypto, it meant Bitcoin. Nobody really paid attention to blockchain technology until around that era of Ethereum coming along. And even today, when the Bitcoin ETFs got launched almost 2 years ago, January of 24, that was all it was, Bitcoin. That was your only option, your only choice. And yet, if you ask a financial advisor about any other asset class, would you ever tell a client to buy a given stock as their exclusive exposure to that asset or a given bond? Of course, the answer would be no. We all believe in diversification. We've all been schooled and trained in that. And yet, when it comes to crypto, there's a whole lot of people who are Bitcoin and nothing but Bitcoin. So talk about that, the way that's been, but contrast it to the opportunities and options available today.
Yeah, absolutely. You're 100% right. I think the closest analogy for people who are not intimately familiar with crypto is to think about the early days of the internet. And in the early days of the internet, there was email, and that was basically it. And you could have looked at the internet and said, I'm going to invest in email. In fact, if you go back to Mary Meeker's sort of market leading internet report that really set the stage for the internet boom, she talked about email as the largest category in the internet, and then everything else is this sort of sub bucket. But of course, today the internet means many things. It means Google, it means Amazon, it means Salesforce, it means Netflix, it means Uber, it means Nvidia, it means ChatGPT, it means a million different things because it's a general purpose technology that can be used for multiple applications. And the same is true in crypto. Crypto is a general purpose technology that allows money and property rights to exist and move natively over the internet. And the first application of that was Bitcoin. And Bitcoin, I think of essentially as digital gold. It's a way to store wealth outside of the government. It's an incredible invention, maybe one of the most important inventions in the last 50 years, certainly in finance, maybe in finance in the last 100, 200 years. It's an incredible invention. Today, it's worth $2.5 trillion. I think that could be $20 trillion in a decade. I'm very bullish on Bitcoin. But there are other things you can do with blockchain technology, as you were hinting at. You can move dollars over blockchain technologies, and they move faster and cheaper than they do over traditional rails. You can move stocks over blockchain technology, and they move faster and cheaper. You can have applications that work like banks, but don't have any intermediaries that let you borrow or lend or trade or move money all over different crypto assets. And the idea between crypto indexing, the reason we launched the very first crypto index fund in the world in 2017, which is today the largest crypto index fund in the world, is that most investors just want to own that. As you said, we don't own one stock, we don't own one bond, we don't even really own like one commodity or one real estate investment. We own a diversified basket so that we capture the theme. And I think that's going to be true in crypto. Right now, most people are Bitcoin only, but I think in the future, most people are going to be index first. And we're excited to be part of the movement driving that forward at Bitwise.
But let's dive deep into that, Matt, because you have been, as you said, you're very bullish. You just predicted a 10x increase in the price of Bitcoin over the next decade. Right now, it's about, what is it today? 110,000, and you think it's going to hit 1.2 million 10 years from now. If that's true, and I don't disagree, by the way, you know, I'm in sync with your attitude, then why do any crypto other than Bitcoin?
Yeah, well, 1.3 million, just to be precise. So
Sorry.
even more bullish, Rick. Well, there's two answers to that. The first answer is that there are other very large markets in crypto, right? Like stable coins are $300 billion today. The US Treasury thinks they're going to $3.7 trillion by the end of the decade. Those are all issued on Ethereum, Solana, and Tron, which are other crypto assets outside of Bitcoin. Every time you move a stable coin, it benefits one of those blockchains. That's also a multi-trillion dollar opportunity. So why just have one multi-trillion dollar opportunity, one mega unicorn, when you can have two or three or four or five? And then the other reason is in any new area of the market, it's just very hard to know who the winners will be long term, right? My family had a Betamax. I remember MySpace. I remember using Yahoo. I'm not at all saying that Bitcoin or Ethereum or Solana is the Betamax of crypto. That's not what I'm saying. But I'm saying that even for someone who works in crypto 24/7, and even someone who has a global research team, I can't tell you with certainty whether Bitcoin or Ethereum or Solana will be the largest crypto asset 10 years from now. What I have the most confidence in is that crypto will be much more important in 10 years. And if that's the bet you want to make, why not just own the basket? As Jack Bogle said, don't, try to find the needle in the haystack. Just buy the haystack. You can buy the haystack in crypto, and I think it's a 10 or more X opportunity over the next decade. And that's just the easiest button to push.
And of course, it makes an awful lot of sense. And at Bitwise, you make it really easy because of BITW, the Bitwise 10 Crypto Index Fund. That holds 10 of the largest digital assets. We'll pour into some detail on that in a little bit. But it's a cap weighted index, which means Bitcoin and Ethereum are representing what percentage of BITW?
Yeah, they're north of 85% of the portfolio, so a very significant percentage.
And so, on that basis, why should anybody bother buying anything other than Bitcoin and Ethereum? Is it the same argument you just gave, diversification, not knowing
Uh,
who future winners?
it's diversification and also because you're busy. So the people on this call who are managing portfolios for clients are spending time talking with their clients, thinking about their lives, doing tax planning, doing diversification, thinking about their stock, bond, commodity, etc. portfolios. Do they have time every day to ask themselves, has another crypto asset emerged that's become really important? Has Solana taken momentum over Ethereum so that if you're Ethereum only, you're missing out on this new area? Is there a new challenger asset that's emerged? The beauty of a market cap weighted index is you don't have to worry about that. Every month in the Bitwise 10, we look at the 100 largest assets in crypto. We screen out the assets with risks, and then we make sure the Bitwise 10 holds the 10 most successful crypto assets. And we do that every month. So if a new asset like Solana emerges, it goes into the portfolio. And guess what, Rick? If Bitcoin is all that crypto creates, which I don't think is true, but if Bitcoin is the only winner and it goes to $1.3 million and everything else goes to zero, the Bitwise 10 will eventually become 99.99% Bitcoin. That's why we made it market cap weighted and cap assets as some other indexes do, because you want to win no matter what happens. If Ethereum becomes by far the largest asset, it will just own more Ethereum. If a new asset emerges that becomes a 100 billion or $1 trillion asset, it will own that as well. It's just designed to make it easy because people are busy and they can't monitor this and it changes every day.
So it sounds like part of the reason you're owning these 10 cap weighted is, I'll say, in case you're wrong, meaning if you might not have picked the one that's best, but by owning the top 10, you'll just let nature take its course. It'll
That's
self-correct.
exactly right. It's a little bit of intellectual humility, which is born from seeing disruptive markets time and again. I mean, I know it sounds crazy to people, but for a while, search was Yahoo's market to lose, and no one had heard of Google. And you just see this time and again. You can't be certain. And if you're talking about an opportunity that's so large, you don't want to be the person who called crypto, said this is going to change the world, and then bet on the wrong coin, which went to zero. And then your family is asking you, you were so brave, you got this right, and then you picked the wrong, like you don't want to be that guy.
And you're kind of addressing the question Jake just typed into the Q&A. He's like, isn't it really just a crypto four index in practicality because the bottom six really have such a small total AUM relative to the top four?
Yeah, I think that's right. But I would say that crypto moves very quickly, right? And so the reason it's 10 and not four is we want to capture assets like Solana that enter the index and move up really rapidly. And so you want to diversify your exposure beyond just the top four. So you're capturing these assets early in their development. You're going to see some of these new assets emerge in crypto as we enter this regulated market with stablecoins and tokenization really taking fold. I think you're going to see some of those assets that are beyond the top four start to become really significant as the real world applications of crypto become important. And having those already in the portfolio is great. And again, if I'm wrong, you still have 90 whatever X% of the portfolio in those large cap assets. So you're sort of covered either way.
I think it also offers a benefit that you alluded to regarding ease. Uh, Advisors don't want a new set of workload. They don't want to have to retrain their staff, reculturalize their clients, add a new tech stack. This is a simple, easy way to create diversification that is probably otherwise going to be elusive, if not for the advisor, certainly for the client. And it's a way for the advisor to demonstrate adding value, saying to the client, I can give you exposure in a manner you're never going to be able to pull that off on your own. Even if you could pick them, are you going to rebalance them every month?
It's exactly right. It also, in my view, protects advisors from 6 months from now, when there are all these stories about how Chainlink is a critical piece of the ecosystem that's allowing us to move into tokenization by allowing blockchains like Ethereum to know what's going on in the outside world. And I think there's a very real possibility that happens. I think Chainlink could be on the front page of the Wall Street Journal. And then your client comes in and says, I'm reading about this Chainlink thing. Should this be in my portfolio? And you get to say, it already is. We've had it since we took on this position. It was a small piece, now it's a bigger piece. We have that covered. And I think that just gives a lot of comfort to the financial advisors of the world who have clients that maybe are savvy about crypto or reading about crypto. You're ready to have the conversation because you already have exposure to the 10 largest assets.
So as the crypto marketplace is growing, we're beginning to see the natural growth in product availability. It began with the Bitcoin ETFs, then there were the Ethereum ETFs. Now there's a plethora. We've got buffer ETFs and yielding ETFs and option ETFs. We're starting to see combination ETFs, TW, not yet an ETF, we'll talk about that in a little bit, is an example of an index. There are other funds that are being created, being brought to the market. You've got several of them that are creating the index approach. Talk about the factors that advisors need to be looking at, because I think advisors are more interested naturally, the way they run money on a passive basis, to lean toward indexes anyway. So, in the world of crypto, how do you choose the right index product?
Yeah, it's a great question because the indexes are very different in the world of crypto. I think you really have to look at the design of the index and then the expertise of the index provider. And let me break that down one level for you, Rick. On the design of the index, we mentioned at the top, there is this big divide between indexes that have market cap weighted exposure and indexes that cap the exposure of the largest assets like Bitcoin and Ethereum. In crypto, that's a very active decision because Bitcoin is such a big piece of the market. And if you're capping it at, say, 30%, you're making a very strong active bet against Bitcoin and in favor of these other assets. Maybe you want to do that, but that's not the easy button. That doesn't guarantee you that you have exposure to crypto no matter how it develops. So I do think top level index construction really matters. And then indexing expertise matters. This is a emerging or frontier market. Particularly, you need an index that screens out assets that have significant binary risks. One of the things we're most proud of at Bitwise is we've been running this index for 8 years with live money, right? $1.6 billion in the fund, give or take right now. We avoided many of the largest blowups in the crypto market. So, as an example, Luna, the stablecoin pair, which famously became the fourth largest crypto asset, never entered our index, even though it's called the Bitwise 10. Why did it never enter our index? Because our index committee, with deep expertise in crypto and traditional indexing, identified the flaw that eventually led to its unwind. And so we evaluated it every month and rejected it every month, and we protected our investors from that. So you do need to look at the risk screens in the index that weed out assets like Luna, like FTX's token, that may have these extraordinary risks because this is an emerging market.
You mentioned that the issue is not merely what's in the index and what caps may there be, but the depth of the provider. There's nothing like success to create imitators. And the ETF industry is really good at one thing, as you well know better than anybody. They're really good at inventing product.
Yes.
And they're really good at following trends. They're really good at capitalizing on investor interest. Is there a risk that we're going to have so many Me Too products, people creating variations, alternatives, simply to try to be different, when in fact there's no fundamental, legitimate investment thesis behind what they're doing? And is that already beginning to happen?
Oh yeah, you're seeing a plethora of index-based products hit the market, and I don't think they're all extremely well designed. I don't mean to be critical. I would say that the thing you want to look at is, does the provider developing the index have both traditional indexing expertise and crypto native expertise? Because there are important lessons from both the sort of 50 plus year history of index funds. There are important things to learn there for managing turnover and managing tax, and then the crypto native side to evaluate risks and make sure you're capturing the real opportunities. We're very proud at our index committee that we have three people on our advisory board. Myself, deep background in ETFs and edited the Journal of Indexes. Shrikant Dash, who was the head of indexes for Bloomberg and sat on the S&P Index Committee, and Spencer Bogart, who's a noted crypto VC and was Wall Street's first analyst ever to cover Bitcoin. That combination of indexing expertise and crypto expertise gets expressed through the things like the risk screens that remove assets like Luna. And so as you look at this plethora of products, and everyone is going to file an index-based ETP, just remember that there are real differences. This is not three S&P 500 indexes. These are different indexes that will hold different assets, and you should think about the risk screens and the expertise behind them. I think it'll make a big difference.
So I'm going to mention three categories where there's sufficient availability of product that lead to the opportunity for indexing. Talk about these three categories, add additional categories if you like. Um, Crypto itself, the different digital assets and tokens, the picks and shovels approach, the companies, publicly traded firms that are in the space, and the Bitcoin treasury companies that are, the strategy of the, and Michael Saylor's approach that so many are now doing. Talk about those three, and if you want to add any others to that category, and what Bitwise thinks of each of those different areas.
Yeah, I think the first two are absolutely fundamental. So my perspective as an investor is I want to own the market as my starting point. That's the core of the portfolio. And then I make satellite allocations to over or underweight things that I feel particularly excited about. In crypto, the first two things you mentioned are the core of the portfolio. So index-based exposure to the largest crypto assets on a market cap weighted basis. As
That's
mentioned,
BITW.
that's BITW, our Bitwise 10 product that gives you exposure to everything that's happening in the crypto asset space. And then index-based exposure to crypto equities, because that's another important part of the market where you have companies like Circle and Coinbase and Galaxy that are building on top of crypto and monetizing that in a traditional equity wrapper. If you have those two products at the core of your portfolio, you have broad-based exposure. It's like owning Vanguard's Total World Index, where you own every stock. The equivalent to that in crypto is BITW and BITQ, which is our crypto equity portfolio. Now, it's important they're well-designed products, they're pure plays, etc., but that's the core. You mentioned digital asset treasuries. That's an example of something I consider a satellite or a subsector of the exposure. Digital asset treasury companies, firms like MicroStrategy that buy and hold Bitcoin. Some people love them, some people hate them. Some people want to use them to try to generate excess returns or alpha above the core return of Bitcoin. So we have a product in that space that holds every company in the world that has at least 1,000 Bitcoin on their balance sheet, and we rebalance that on a quarterly basis. You're going to see other subsectors, Rick, I think, develop in both of these areas. You'll probably see DeFi indexes, and maybe you'll see DPIN indexes on the crypto asset side, or maybe you'll see payment stablecoin indexes. On the equity side, you'll see stablecoin plays. You'll see a variety of other things. But what I would emphasize for most people is the core is broad-based crypto exposure, BITW, broad-based crypto equity exposure, BITQ. If you want the market cap weighting, it's about 4-to-1 in terms of their importance in the world. So 4 BITW, 1 BITQ. That gives you your base portfolio, and then you can make satellite allocations on top of that.
So we've got just a lot of questions that people are putting in, and a few directly related to BITW and BITQ. One big distinction between them is that one's an ETF and one isn't, and that has an impact on fees. So elaborate on that.
Yeah, that is right. So BITW right now is an OTCQX traded trust. The way most people intuit that is it's like GBTC, the grayscale product, before it converted to an ETF. So BITW is at the stage before it converted to an ETF. We've applied to the SEC to convert BITW into an ETF. We feel very optimistic that that will happen if and when the government reopens.
I hate when
Uh,
you say if. The government better reopen.
I don't know, Rick. I don't know. Anything's possible in this new political world. This is already one of the longest shutdowns in history, and the poly market odds are starting to push us into late November. So it's not looking fantastic. Of course, it will open eventually, but we intend to convert it into an ETF. You mentioned fees. These OTCQX traded products are really expensive to run. It's a complex product wrapper, and that has kept the fee of BITW high. It's 250 basis points. We intend to dramatically drop that fee when it converts to an ETF. I can't share because it's a competitive secret exactly where we'll put that fee, but we know that that is not an ETF fee, and the ETF is a much more efficient wrapper. So you can expect that fee to go down. And of course, the other big impact, if it turns into an ETF, is that it should not trade at premiums or discounts that are substantial because of the ETF mechanism. Right now, it has and can trade at premiums and discounts. But again, this is a top priority. We're 100% committed to moving it into an ETF structure.
Let me mention the arbitrage opportunity that some people are looking at. BITW is currently trading at a discount. And the theory is that when it converts to an ETF, the shares will trade at NAV, eliminating the discount. And if that proves true, then you capture the delta, which some argue more than compensates for the annual fee, which, by the way, is an annual fee. You're talking about potentially a matter of weeks for that fee to collapse dramatically, yet capturing the delta. Do you have any strong objection? I know there are compliance issues in your commentary on that, but what do you
No,
think?
yeah. All I can say is, of course, we cannot guarantee that it will convert to an ETF. We can guarantee that we have applied to do that with the SEC, and by their good graces, we will make it happen.
I will say, since Matt won't or can't, that if you believe, and Matt will be happy with the word if you believe in the arbitrage opportunity, this makes BITW a particularly timely investment, one that won't last forever simply because of the nature of the transaction to ETF status. Um,
I
Matt's
love
saying
it.
no. Yeah, so we'll leave it at that. Um, the um, talk about insurance companies. One of our attendees has asked, are they talk about their overall, generally speaking, involvement in crypto. Insurance companies are some of the biggest investors in the world because of all the money they've got. I think they're dominant in the real estate institutional space, commercial office buildings, et cetera. Are they engaging in crypto to any degree with their investment strategy? And at what point will their whole life or universal life contracts, where they or variable life contracts, where they give the policyholder the opportunity to build a portfolio, will they create a crypto allocation in there? Any sense of
Oh
what's
man,
happening?
that's a great question. I really love this question. You and I have talked about this before, Rick, but I sort of think of a stack of investors of varying degrees of quote unquote institutional sort of orientation from degen retail traders all the way up to central banks. And if you think about that stack, what crypto has been doing has been steadily moving up, right? Degen crypto traders, retail traditional investors, RIAs, broker dealers, pension funds, endowments, insurance companies, sovereign wealth funds, central banks. That's like roughly the stack. I'm sure I left out one or two. Um, at this point, family offices, at this point, crypto has, I would say, pretty strongly penetrated about half of that stack. So I think retail investors of both types are engaged in crypto. RIAs are very engaged in crypto. Family offices are very engaged in crypto. We've seen broker dealers recently start to allow their advisors to put crypto into client portfolios. Morgan Stanley famously came out 2 weeks ago saying you can do up to 4% Bitcoin in risk sensitive portfolios. So those have really started to move into the mainstream. The things above that, what you're seeing are idiosyncratic examples. So there are endowments that have allocations. Harvard has an allocation. MIT has an allocation. Emory has an allocation. But these are sort of a handful of names. There are pension funds that have allocations. There are insurance companies that have allocated to venture in the crypto space. And there are insurance companies that have nibbled around the edges of crypto exposure in their GP. Mass Mutual, as an example, has
Yeah.
been at the forefront of this. They're actually an investor in Bitwise, but they are sort of leading the charge. And we have had meetings with insurance companies about crypto. So I think they're orienting around it in the same way advisors were really orienting around it about 3 years ago, but they're at that sort of pace. Um, I would love to see insurance products to take the other angle of that are built around crypto and Bitcoin, or at least incorporate those. That is still very early as well, right? We are just now breaking down the barriers that prevented crypto from going into things like 401ks. I think there's similar barriers into mainstream insurance portfolios. There are, of course, startups that are offering sort of Bitcoin-backed life insurance policies, but those are on the edges. So my message here is all of this is coming, just like advisors seemed far away a handful of years ago, but those of us in the space could see the seeds of sort of exponential growth. I'm seeing the same seeds in these other categories, including insurance, where you have a few leaders who are nibbling at it. I bet that will be twice as big next year, and then 4 times as big, and then 8 times as big, and then pretty normal by 2030. But we're very early in that development cycle.
Yeah, and help people understand why you're saying by 2030. It's still 5 years away. It's the, I'll call bureaucratic methodological, is that a word? Approach that these committees take, these boards and investment committees and due diligence teams and risk compliance, et cetera.
They move at a different time frame. I used to say it was true for a long time that the average Bitwise client allocated after 8 meetings with us. And if you think about these boards studying Bitcoin, even if they jumped right on it the day the Bitcoin ETF launched, and they've talked about it at every quarterly meeting, which is the cadence they meet at, they still haven't gotten to the eighth one. And that's if they were like cutting edge. So really the earliest you can get through that platform is 2026, and most of them move slower than that. These people also have very good jobs, Rick, and they don't want to lose those jobs by sticking their neck out. So they're culturally conservative. But I've just seen it happen on every category of investor, where all those things were also true of broker dealers, right? They started looking at Bitcoin after the Bitcoin ETFs launched in January, and they were like, no, we'll never do it. And guess what? Today you can. We're going to have a call in 6 months or something where Vanguard opens up exposure to Bitcoin, right? This is just what happens. And they're just moving at that. They move at a slower cadence than we would all like, but that is their native cadence. And for good reason, they're conservative institutions.
Uh, yeah, because they're first and foremost focused on two things: investor protection and their own brand and
Yes.
reputation. So it does certainly make sense. What it really means is that the flows are going to come. They may not come as fast as everybody expects or wants. They will come, and your choice is: do you want to invest before the flows hit or after?
That is exactly right. And the other thing I would say, if you think about it, like what really keeps these people up at night, it's sort of blow up risk. It's FTX, it's Mt. Gox, it's these negative headlines from blow up risk. One thing that I think is really important in crypto is that we've removed a lot of those risks. Right now, we have institutional qualified custodians from names people trust. Right, soon you'll have Bank of New York and others custodying crypto. We have institutional trading. We have laws in Congress. So we're removing that blow up risk, which does make it give me even more confidence that they're coming. And as you mentioned, knowing that they're coming, you have an opportunity to get in ahead of it, just like you had an opportunity to get in ahead of family offices a few years ago, and you still have an opportunity to get in ahead of broker dealers, but they're clearly coming. You can front run that as an individual. It's a very exciting opportunity.
Corey's got two questions. First, you mentioned 1.3 million in 10 years. What do you say by year end?
Oh, by year end, I'm actually very optimistic. I think we're going to end the year at new all-time highs. When I look at what's going on in the market, you have this persistent bid from ETFs that I think is not slowing down. There's some volatility in it, but there is just persistent demand from traditional investors to move into Bitcoin. You have rising concern about the debasement trade. You have pro crypto regulatory developments. You have lower interest rates. The economy is still strong. When I put all those things together, I think, we put out our forecast in December for Bitcoin to get to 200K by the end of 2025. And that's obviously a long way from here. I'm not sure we'll get all the way there, but I wouldn't entirely rule it out. And I think we're going to move strongly in that direction. October, November are traditionally the best months for crypto. I'm very optimistic for the end of the year. I think we're set up for a surprising run that will lift Bitcoin to new all-time highs before we celebrate the new year.
Corey also asks, given that BITW's expense ratio is currently 250 bips prior to its conversion to ETF status, that he notes could be causing an investment committee to pause because they're very sensitive to expense ratios. So, what would you say to that committee regarding that?
No, look, I think that's reasonable. We know that it's a high expense ratio. As mentioned, the product structure is very expensive to run. We do intend to bring that expense ratio down once it's in the more efficient ETF wrapper. So, I understand that people are sensitive to that. As you mentioned, there may be this arbitrage opportunity, but that may be too complex for people who want a simple answer. They can buy our Bitcoin ETF, our Ethereum ETF, which are much cheaper. For me, I'm comfortable holding BITW in my personal account because I like the fact that it's an easy diversified exposure and I have confidence in where it's going long term. But if that number is too large for your committee, I completely understand. We intend to address it when we convert it to an ETF.
I too have owned BITW since its inception, way back when, and continue to hold it. And you're absolutely right. If they are purely fee focused, or predominantly, then you just buy the Bitcoin ETF and the Ethereum ETF, and you'll have 85% of BITW.
That's great too. We're happy to do that. And those ETFs are extraordinarily cheap. They're 20 basis points because the ETF wrapper is so efficient. There's a lot of excitement around Solana, around Chainlink, around XRP. You may want to consider if it's worth having exposure. But Bitwise is just a crypto asset manager. We aim to design extraordinarily high quality products that help people express what they want to in the crypto market. If that's BITW, that's fantastic. If the fee is too high, BITB and ETHW are extremely low cost. And as you said, you can gain exposure to 85+% of the portfolio that way. Great. I'm happy either way.
You're essentially a cafeteria, and the only thing you're promising is that all the food tastes good and none of it's poison.
That that's exactly right. We are aligned with our investors and we want to bring that fee down. And we will as soon as we can from an ETF perspective.
Constance wants to know the minimums to invest in either of the two funds.
Yeah, so it's these are shares that trade on the New York Stock Exchange. So it's a share or a fraction of a share. You could probably put $10 to work if you want.
On a platform like Schwab or what have you.
Correct. Yeah.
And Charles wants you to reiterate your recommended allocation between the two of them.
Sure. Yeah. So 80/20 crypto assets versus equities. So 80% crypto assets, 20% crypto equities. This is not a personal recommendation for a portfolio. What I was saying with that is if you take the market cap of the crypto asset market and compare it to the market cap of all crypto companies, public and private, you would end up with about that 4-to-1 ratio. So that's like, again, that's like the S&P 500 of crypto would be putting those two together. You'd have broad-based exposure.
Arnett wants to talk about XRP. What's your comment there?
Oh man, XRP is a great example of an asset that I love to have in the index. Here's the thing about XRP. There are people who love XRP. There are people who hate XRP. There are reasons to be bullish on XRP. Those reasons include it's one of the longest standing crypto assets. It has a large community that's very supportive. It's related to and backed by a company with a huge balance sheet. It has one of the most efficient and faster blockchains in the market. Those are an incredible set of primitives that could allow it to be very successful. The con on XRP is that it's been in the market for many years. The token economic driver of value to the XRP token is unclear. The real world applications are somewhat limited, in part because it was facing an existential threat from the SEC for many years. And as a B2B blockchain, that's just a business killer. So I look at XRP and I say, here's this asset that people have very divisive views on. It's a binary asset. There's a world in which it's very successful because it executes on its strategy well and it becomes a big player in stablecoins and tokenizations and payments. And there's a world where it doesn't and its value goes to zero. For an asset like that, I want it in my portfolio, but I don't want it to dominate. I want a little piece of it, and I don't want to have to monitor it to see if it's succeeding or not. That's the beauty of the index product. It's like I forget, 3-4% weight. It has exposure. If it works out, great. If it doesn't, you still have 96% of the portfolio in other assets. I think it's a great example of why indexing is so valuable because it's really hard to know, will XRP succeed or not in the next few years? Anyone who tells you definitively that they know, I think hasn't considered the opposing case very carefully.
Let's talk about the overall asset allocation. Mark writes the following. He says, Rick has said that a diversified portfolio should be holding 10% or more in crypto, with his belief in the exponential growth in crypto in the future. Would you have the similar view? What's your feeling on the proper weighting in crypto? And
Oh, I love that.
what Mark's referring to is my white paper, uh, saying that you should have somewhere between 10 and 40% of your portfolio in crypto, which kind of makes some people's heads explode. So, Matt.
Well, that upper number is close to my personal allocation. So that gave me great comfort that you put it out there. Rick, you endorsed what I did. Look, I think it depends on the client, obviously. What the data suggests is the biggest bang you get is getting off zero. So if you look at how crypto has impacted your risk-adjusted returns in a portfolio, in the first handful of percent, let's say 2.5 to 5%, you really get a dramatic increase in the Sharpe ratio of your portfolio. It's extraordinarily additive. As you add more crypto above 5%, you continue to improve your statistics. And I think there's a strong case for getting allocations that are above that number. We're starting to hear 10% from more of our advisor clients, but you are taking on more risk. The portfolio is getting more volatile. You and I would agree, Rick, that crypto is a volatile asset. And while it's not correlated to stocks and bonds, as you start getting to that 10, 15, 20%, you do get more volatility in your overall portfolio. So it really depends on who you're talking to. The most important thing is that to me, 0% is wrong, right? If you're looking at the market right now, stocks are what, $110 trillion, crypto is $4 trillion. If you're not at like 3.5%, you're effectively short crypto versus the global benchmark. So I think zero is wrong. A lot of the value lies in 2.5 to 5. And then how much you want to go above that is how much risk your client can tolerate. And that's really, you know that better than I do.
Yeah, I think that's very valid. And it really comes down to how closely you want to follow portfolio optimization strategies under MPT and Markowitz's theories. Because if you do, which most of us generally do with our portfolios, you'll be where Matt says, 3 to 5% allocation. But recognize that while you might be optimizing the portfolio, you aren't maximizing the profit potential. So I personally think that most folks, because of the challenge in accumulating enough assets to meet their needs in retirement for as long as they're going to live, because they need to frankly be more aggressive than they may be comfortable with in order to achieve their financial goals, you need to give up a little bit of that optimization in favor of maximization efforts, which argues more than 5%. Somewhere, I think, between 10 and 40. But Matt said it best. It's up to the client's circumstances and consultation with their advisor. And so kind of there you are. Uh,
Absolutely.
but
Yep.
I also would argue that if we have a problem in the world of crypto allocations, it's easy for us to argue over a beer whether we should be allocating 5 or 50. The biggest problem, I think, is that we have far too many people allocating too little than too much.
Yeah, I absolutely agree. Again, I would go back to that point. If you're at zero, you're off benchmark. It's like not owning Nvidia, right? Like, would you have S&P 500 exposure but not own Apple? You probably wouldn't. If Bitcoin were a company, it would be one of the 10 largest companies in the world. If crypto were a company, it would rank right up there with Nvidia. It's roughly the same size. So if you're 0% allocated to crypto, you're really off market. And you're off market because you're probably thinking about crypto as it existed in 2010 or 2015 before it was an institutional asset. When you really, it was to your detriment, but you could have ignored it and said it's too small to matter, it's too risky to asset access. Now, as we said, the largest institutions in the world are allocating to crypto. Ray Dalio, Stan Druckenmiller, Harvard, Emory, that we could go on the list. The Abu Dhabi Sovereign Wealth Fund, Luxembourg Sovereign Wealth Fund just allocated to crypto. If you're at zero, you're off benchmark. And I do think there are more people who are underallocated than are overallocated. I think you said that extremely well, Rick.
And I think you can prove that you're smarter than Harvard because they paid 116,000 per Bitcoin. You can buy it at 110. Um, we have a link in the chat to Bitwise's website, bitwiseinvestments.com, so you can learn all about the different funds Bitwise offers. Also, a link to my white paper, including the one where I talk about the 10 to 40% allocation potential. Talk about staking. This is one of the hot new conversations. Grayscale, in the last couple of weeks, got approval to add staking to their Ethereum ETF. You have an Ethereum ETF. Will you also allow staking?
Yeah, we're looking at it very closely. Bitwise is a big player in the staking world. We have a whole unit of our company called Bitwise On-Chain Solutions that does staking of Ethereum primarily for institutional clients. and we stake something like $5 or $6 billion in assets in ETH. So it's a space that we believe in. It involves locking up your Ethereum to validate transactions on the network and acting honestly with high uptime to make sure you're a positive contributor to ETH. If you do that, you earn a yield, which is a couple of percentage points per year. And if you mess up, you lose your ETH. So it's not riskless. You have to do it exceptionally well. And it's not the major driver of return, right? We're not investing in ETH because we want to get US Treasury style 3% a year yield. But if you can do it safely and securely, then of course you want to do that. And Bitwise, as one of the leaders globally in ETH staking, is looking at how to do this within our ETFs. We're going to do it when the time is right and with the appropriate safeguards. But we're looking at it.
Travis has a comment here. It's a wonderful comment. You'll love it, Matt. But I want you to elaborate on what he's talking about because not everybody's familiar with this. I wholeheartedly agree with Travis. I want you to elaborate. He says, Matt's weekly memos are a great read and insightful on the crypto industry. Highly recommend.
Oh, well, thank you, Travis. I really appreciate it. And thank you, Rick. Yeah, I write a memo every week about the biggest topic in crypto. This past week, for instance, I wrote about why gold is rallying while Bitcoin has been treading water and what that means for the future of Bitcoin. I try to keep the memo short. I know people are busy, so I try to keep it under like 1,000 words. 700 or 800 words is my sweet spot. I want you to be able to read it in 5 minutes and know the most important thing in crypto, have an answer to the most common question you'll probably get from clients that week. You can sign up for it at bitwiseinvestments.com/CIO memo. We don't spam you with other things. We just send you the memo, and it's always, again, designed to be read in 5 minutes. It's a labor of love, but we get great feedback from it. So I really appreciate the shout out.
Yeah, I was just going to say one of the best things about it is that it's short, and it won't take you a lot of time, and it's clear, it's concise, it's impactful, and it gives you commentary you can share with your clients, which is even best. And so, yeah, I encourage you to subscribe. We will put in the chat the link to it so that you can easily access and sign up, which of course is free. Uh, Great question. Why the Bitwise 10 crypto index? Why not 15 or 25?
Yeah, great question. There are a couple of answers to that. One is that 10 is a nice round number. So I'd be lying if that didn't play a factor, right? We didn't call it the Bitwise 8 or the Bitwise 9 or the Bitwise 13. That would have been odd. So 10 is a nice round number. 10 also captures about 85% of the investable market cap in crypto. And I think that's a really nice number because the reality of crypto, as you and I know, Rick, is that there be dragons at the long tail of crypto, right? There's 17,000 crypto assets. I think most of them are worth zero. I think a lot of the really small stuff is scams. So you want to have enough that you're capturing institutional quality assets that can be custodied at leading custodians that are liquid, but not so much that you start to have meme coins or you start to have fraudulent projects, etc. Right now, 10 is the sweet spot. We monitor this, we think about it, we ask questions about it every month or every quarter. Over time, if we see an expansion of really high quality projects beyond the top 10, then we could expand the index. That's possible. You've seen that in other index-based strategies. But right now, 10 really gives you a sweet spot. There's some great assets in the index. I think if you looked at the assets that aren't in the index, you might agree that you don't necessarily want exposure to them. So I think it may be the sweet spot.
Corey wants to know if he can fly you in for a meeting with his investment management team to help him convince them of why they ought to be doing crypto and the models.
I love that. Absolutely. We do that all the time. That's one of the things that we love doing. Just drop me an email, Matt at bitwiseinvestments.com. We're very open. That's what Bitwise exists to do. So absolutely. Yeah, let's make it happen.
And we'll put Matt's email address. There it is. Thank you, Michelle. Matt's email address is in the chat, so you can just click that button and send him an email right now. We've uh, we've got a lot of folks increasingly expressing concern about the overall status of the economy and the financial markets, not just here in the US, but globally. The number one thing that people are worried about, and I'm strictly talking economy, I'm not talking about the geopolitical horrors we're all worried about every night. But the national and the global debt, um, it's got a lot of people worried. A lot of people are arguing this is why gold is hitting all-time highs. Um, here's the question that one of our attendees has asked. If we were to go through another 1930s style depression, what would that do to the price of Bitcoin?
Mm, that's a really interesting question. I too am very worried about the debt. The debt clock in New York has run out of numbers, which tells you something. Uh, it's really frightening. And I would add that the only thing Washington can seem to agree on, we can't even open the government, but we can seem to agree on just spending more money and building more debt. So I'm not optimistic to it. I don't know exactly what will happen to Bitcoin in that scenario, but I do know that if what we're going to see is spiraling debt and spiraling money printing to cover that debt, the asset I want to own more than anything else is Bitcoin. There are, I guess, two ways we can enter a 30 style depression. One would be sort of a march toward higher and higher inflation and greater debt burden. And in that scenario, boy, do I want to own Bitcoin because it's exactly a hedge against that. The other would be that the government sort of gets religion and goes through a massive period of austerity, and we start having budget surpluses again, and the debt comes down from 38 trillion back to, a trillion or something. I just think that's very unlikely. So in that scenario, Rick, crypto, Bitcoin specifically would probably underperform because the government would be making the dollar sound again. I'm just not willing to bet 100% of my portfolio on the government doing that. I see no indication that we're not just going to continue to ride the debt to $100 trillion and then eventual almost disaster over there.
Yeah. One of the other questions that comes up a lot is pointing to the 4-year halving cycle. Historically, that has been a pretty reliable measurement of what to expect from Bitcoin. Is that cycle still as relevant as it used to be?
I don't think it's as relevant, and there are a couple reasons for it. One is that having definitionally becomes half as relevant each 4 years. So the supply impact from the most recent halving is half as big as the one from 2018, which was half as big from the one from 2014, and so on. The other is that the 4-year cycle previously has coincided with sharp increases in interest rates during 2022 and 2018. And I think interest rates are, if anything, heading down. So I think those forces are much weaker. And countervailing that is what we were talking about earlier, this cascade, this ladder of different types of investors just moving into crypto. And that's going to play out over the next decade, really. We're going to see persistent inflows from these professional investors as they move into crypto. I see nothing slowing down that train. That moves on a 10-year time horizon. I think this may be more like a 10-year cycle and not a 4-year cycle. That doesn't mean there won't be volatility. That doesn't mean there won't be sharp pullbacks. Of course there are. An asset can't go from 100K to 1.3 million on a steady slope upwards. That's just not the world we live in. But I don't think we're in the 4-year cycle anymore. I think 2026 will be a good year for Bitcoin. I think it'll have positive returns. I think this institutional cycle is the dominant cycle to be thinking about.
Yeah, I think you're right. Uh, one of the arguments that people make for the enthusiasm, I've heard you say this, Matt, I certainly have, is the Trump administration's strong support. And we're now seeing it from both parties in Congress. We've already seen the Genius Act. We're seeing more crypto legislation coming. And we now have gone from headwinds to tailwinds. All the Biden era prohibitions have been rescinded, and we're seeing a lot of excitement and engagement from Wall Street and the financial sector because they're now allowed to for the first time. So the fear is, might the next president in 28 reverse it back? And what if the Democrats win in 2028? And can they undo all this? And we're right back where we started, and that would cause a crash in prices. How worried are you about that?
Yeah, I'm really not worried. I think it's a good thing to think about, but I'm not worried for two. Very specific reasons. One is if you look at the votes for the Genius Act, which was the bill on stablecoins, it got 100 Democratic votes in the House. It was one of the most bipartisan pieces of legislation that this Congress has passed. The only other piece that sort of rivals it was a piece declaring fentanyl to be bad. Right? Like, so the only thing Democrats and Republicans can agree on is we need to upgrade the financial ecosystem. And I think those Democratic votes show that this is actually a bipartisan issue. A lot of Americans own crypto, and we need to make the financial ecosystem better. The other one is maybe more cynical, but probably important because Washington is a cynical place, which is crypto is being embraced by Wall Street, traditionally one of the biggest funders of the Democratic side of the aisle. BlackRock's most valuable ETF now, from a revenue perspective, is its Bitcoin ETF. You're seeing JP Morgan, Bank of America, and others want to launch stable coins and get into that market. I just think as we go through another 3 years of Wall Street embracing crypto and seeing it as a profit center, they're not going to want to unravel that as well. So I think the genie is out of the bottle. I think it's already bipartisan and will be more so as it penetrates mainstream use. And I just don't see this going backwards.
Yeah, I'll add two additional reasons. One is not only is BlackRock and Wall Street making a lot of money at this, you've got tens of millions of Americans personally owning it, and unwinding it would cause the erosion of that value, and you'd literally be stealing their money. That would throw people out of office pretty quick. So I don't see it happening. More fundamentally, we are seeing legislation for the first time, not merely regulation or executive orders. It's pretty easy for a president to sign an executive order of whatever they want. Biden did it, and Trump then reversed that stuff. But when Congress passes a law, it's extraordinarily difficult to unwind that. And if you want proof, look at Obamacare. Trump said in 2016 he hates Obamacare. He says it today. He hasn't been able to do anything about it because it's a law. And so, with these laws in place by 2028, it's pretty permanent.
I think that's a really good point.
Kyle is following on the heels of Corey. He says, we're a group of LPL reps. And what advice would you give us to get LPL to approve your other products? Right now, we can only use BITW. We'd love to use BitB and ETH.
Oh man, I love that. A, reach out to me, and then B, reach out to the people at LPL and ask them. The biggest way we get approvals, and we've had a large number of approvals of our Bitcoin and Ethereum ETPs on major platforms, is advisors asking for it. So make some noise, say you want exposure, and then reach out with us so we can help coordinate on making that noise. It's very valuable to us and really appreciate the support at places like LPL.
You know, we're getting also, Matt, a bunch of inquiries from LPL reps in particular. I'm not quite sure why just them, or predominantly them. And we are beginning, Don and I, for those of you who don't know, Don Friedman, the CEO of DAC-FP, to begin to work with the folks at LPL to help try to move this through. I think, Matt, it would be possibly pretty helpful if we join some forces together to talk to the folks at LPL and help them train their interior staff as well as their advisors.
Let's do it. I love it.
Yeah,
Absolutely.
that'd be great. This has been a ton of unbelievable content. The level of interest here, we can see pretty clearly from how many people are here, the nature of the questions, level of engagement. I encourage you to visit bitwiseinvestments.com. Link is in the chat. Reach out to Matt, his email address, matt@bitwiseinvestments.com, in the chat as well, because there's no reason not to be engaging in this asset class. It's not only, I think, an outperformance opportunity for the portfolio, it's an opportunity for you to demonstrate value out of the client in a way most advisors are still not yet doing. It's a great way to differentiate yourself. And Bitwise, I think, is perhaps the best way to engage in this in a crypto-only asset manager. So I encourage you to do that. We're big fans of big fans of all the crypto education needed, and not just in crypto, but across the spectrum in the field of portfolio management. On Thursday of next week, we're doing a webinar on bonds and how to design fixed income solutions for clients today. So I encourage you to register for that event. There's the QR code on screen, or just visit dacfp.com. As I mentioned, my white paper, why you need to allocate 10 to 40% of your portfolio to crypto. And my earlier paper this year, the 6 myths that are preventing you and your clients from buying Bitcoin. I encourage you to download both of those, available at dacfp.com as well. And to really become fluent in this conversation, become certified in blockchain and digital assets. All the public-facing staff at Bitwise have achieved their CBDA designation. We encourage you to do the same. You'll really be able to set yourself apart from other advisors. If you haven't read my #1 Amazon bestseller, The Truth About Crypto, I recommend that you do so. And do me a favor, totally off point, pre-order my brand new book that comes out December 4th, The Truth About College. The statistics are shocking. 24% of freshmen drop out, only 62% graduate in 10 years. And yet 10 years later, only half of grads are working in a job that requires a degree. And 20 years later, 42% are still paying off their student loans. College can be the greatest choice of a teen, but it can also ruin their life. So my book teaches you how to help your clients get their children to graduate in 4 years, debt-free, on the dean's list, ready to enter the field the teen wants to enter. You can pre-order the book right now. And if you do, as a consumer, you'll get a couple of exclusive benefits. My 20 Conversation Starters workbook and an invitation to a private webinar where you can ask all your questions about crypto. And if you're an advisor and you buy bulk quantities of the book to give out to your clients as a holiday gift, you'll not only be able to give them the Conversation Starters, but I'll give you a special white label version of the webinar with your video message in it that you can distribute to your clients as you wish. Full details at thetafe.com/college, or click that QR code, and we'll get you that info. Again, Matt, thank you so much for sharing all of this content, all this knowledge. I know you're going to get a lot of questions from everybody here today.
Yeah, thanks for having me, Rick. Thanks for everyone for tuning in.
See you all soon. Thanks very much.
Bye-bye.